correlation analysis. Correlation analysis across major indices. Let's take a look and see what the research team put together today. Correlation analysis among major indices. Although the four major indices may show varying performance over the long term, their day-to-day correlation remains significant. These are just the major stock indices. And you know what's funny is that we've been talking about pairs trades. The reason we put this up here is for pairs trades. I covered my S&P Russell trade yesterday, just because it came in a little bit. I figured maybe I can get this on better prices.
You also covered some of your short spreads that you had.
Yeah, but not enough. Only 20.
Of course not enough 20%. Now because we're rallying, but yesterday was
if
day
we were down,
one.
I would have covered too much.
That's right.
I'll probably reload, just so you know, but we'll see. I guess the point here is the reason we're showing this is because a lot of us do pairs trades, myself included. And if you look at IWM versus the Qs here, or IWM versus the SPY, which is the yellow versus the red, although they all go in the same direction, they've obviously had this massive divergence over the course of the last 2 years. It's just massive. And eventually it's going to go the other way. Eventually.
Sure.
These things always do. Pairs trades are by definition, they do have mean reverting qualities because they're betting on the spread, not necessarily on.
They used to. I mean, they have over time. Sure.
I mean, in this case, it doesn't look like it for almost a year and a half, but they will, and therefore, what's attractive about just looking at this picture is potentially, at some point, selling the S&Ps and selling especially the NASDAQ.
Qs are on the top one.
Yeah. The two top ones.
SPY, then diamonds, and IWM.
The diamonds are a little less liquid in the sense they don't have the same kind of. You don't have the same kind of flexibility.
You're right, but if you were to look at those lines, you would say, yeah, it follows the market.
You can
IWM
buy.
More than
You can.
Else.
If you look at that, you said rather buy small caps here, but the correlation is still going to be crazy high. So the long-term average correlation between each pair is 0.83, and that's over the past decade. So that's pretty high. I mean, the highest you can go is to 1. The pair with the lowest correlation is the IWM and the Qs we just talked about, with a value of slightly under 75. We've seen that value, by the way, go down as low as 45 or 50 when there's just zero. But over time, you look at kind of a 10-year correlation, and it's pretty significant. Now, again, this is skewed out over time, so it's a little bit higher than it is currently trading. But if you think it's going to normalize, that's an interesting trade. Just keep it in the back of your mind.
Sure.
I mean, I like it. It's just, this is 120 months. So it's 10 years. And that makes those numbers look a lot flatter than they really are. This thing is, right now, I'm guessing it's probably 4 or 5, 0.45. But normally.
At the extreme.
Yeah, at the extreme.
But it can stay there for any period of time.
Also, the implied volatilities of these 4 indices typically move together and they stay within a similar range. That's very true. And you can actually track the implied volatilities. You can just look at them. VIX is what we always quote on the show, which is the S&P 500 volatility. But of course, there's VXN, which is the NASDAQ. There's RVX, which is the Russell. And there's VXD, which is the Dow. I mean, I don't think any of those trade except for VIX. I don't think they're tradable. But at least if they are, I've never traded VXN. Is it tradable?
No.
No, okay.
No.
Yeah, just VIX is tradable.
Yeah.
Let's go to the next slide. But they do track each other. And we found that the long-term correlations among the volatilities, with the Dow showing slightly weaker correlations against the other indices, but the reality is that the correlations are extremely high, except for the Dow. Meaning that sometimes the NASDAQ and the S&Ps just run away with things, but the Dow correlation is, is the only thing. And again, we don't really trade the Dow that much, so it's not that big a factor. So what is the correlation between option strategies against the 4 indices? Do we see a similar pattern, and can we use them to diversify our portfolio risk? Now, in the new show we're doing this year on, creating innovating a portfolio for active traders, on the creation of and the management of a portfolio for active traders, we are covering this. And so, but do we see a similar pattern, and can we use them to diversify portfolio risk? And to better understand this, we looked at strangles in the SPY, Qs, IWM, and diamonds, and we recorded their correlations. So the performances of all these indices seem to be positively correlated. And this should not surprise you at all, suggesting that using a similar strategy across these 4 products may not be an effective way for portfolio diversification, but it's better than just being in just one product. One product, just S&Ps, for example, doesn't give you any diversification. Being in a couple of these gives you, some diversification. So the takeaways, not only have all 4 major indices shown a high correlation to their stock movements, but also in their option performances. Trading the same option strategy on highly correlated indices might not provide enough diversification in a portfolio, but traders who seek to risk diversification should consider uncorrelated assets instead and utilize various strategies and deltas. We focus on this so much because there's only so many different things we can do, like get you to stay small, get you to trade often, get you to diversify, that are really kind of mechanical things. Ultimately, the trading skill is just on you, and there's nothing we can do there.
That's
like
true.
What underlines you pick and things like that.
That's true, but we could put you in a profitable, at least high probability trade on entry in something that's liquid, with risk tolerance that fits your trading, and then you run from there.
Yeah.
I mean, that's what else can you ask for?